Thank you so much. Very good. And as we're heading up more or less, thank you so much. We will continue the discussions. You will be around upstairs. So those who feel like taking it a bit further are more than happy to reach out. We're now before the final closing of the closing words and the session there. We're going to have one more fireside. And this is very, very interesting. I warmly recommend you to, if not, bring your friend and hear out the last session. It is about scaling up, as we have here on the set. So the scale up of climate tech and being competitive in an asset-heavy business. Those panels we heard already today, we know that it's already quite the challenge. Where is the balance of getting an investment? Where is the balance of actually showing out something physical, getting some things to scale up, and at which stages? So for this, we have a wonderful example from Finland. We have Cactos, which is the CEO, Oskari, will be joining in and share their story. So let's say a big recycled battery storages. Hasn't been easy, but somehow they've been able to take it out to the next level, already gathered quite the investment round. This will be interviewed by the acting CEO of Climate Fund, so Toni, Mikkonen. So let's give the both gentlemen a warm welcome and looking forward to the discussion. Warmly welcome. Good stuff. Good stuff.
It's been a content-packed 2 days. My name is Toni Mikkonen. I'm with the Finnish Climate Fund, and for the next 25 minutes I have the pleasure of interviewing Cactos CEO Oskari. And you can expect to learn about Cactos and energy storage in general, of course, but hopefully also about some applicable and practical takeaways about scaling deep tech companies. Let's start with you, Oskari. Please introduce yourself and give us a little background on how you ended up co-founding Cactos.
Yeah, thanks, Toni. Hello, everyone. My name is Oskari, and as said, working with energy storage these days. How I ended up there, of course, first, huge disclaimer when talking about Cactos. Cactos is not only me, we have 50 people working at Cactos, and I haven't created Cactos. It's been a big collaborative project. But if I founded Cactos and how I ended up there, I actually, I'm a marine engineer by background, so graduated from here in Otaniemi in shipbuilding. I worked in oil and gas, upstream oil and gas, so oil production. My most recent corporate job was as the head of commercial at a Malaysian oil company. Me and the family spent some years in Kuala Lumpur in Malaysia, and then in Amsterdam, Netherlands. The company was doing upstream production in deep waters, offshore Africa, East Asia, North Sea. Then COVID came. We were in Amsterdam at that time with the family. All of a sudden, location dependency kind of vanished because you couldn't go to the office. And also, in the oil industry, it was kind of a wild moment. I think many remember that oil was even negatively priced at one point. So there wasn't much to do at work. I was still working for the same company, but they said that, well, you can work from wherever you want. Our kids had never lived in Finland, so we moved back to Finland, and I started helping out Finnish private equity funds with renewable energy transactions, so project financing, debt financing for it was mainly wind parks at the time. Then the volume of transactions in wind, in renewables was quite big, and there were so many projects out there that I started wondering that this must have quite a big impact on electricity pricing and the electricity markets. And I started looking into electricity markets. I mean, I have dealt with commodities in one way or the other pretty much all of my career. Commodities are things that are similar. Every unit is the same, so things like metals, oil, gas, grains. Electricity is a commodity as well, and it's traded in a public marketplace. But the thing that makes electricity different from basically any other commodity is the price volatility. So you can compare, for instance, to oil. If there is a 10% intraday price fluctuation in oil, that'll have dramatic real-life consequences. I mean, oil crisis in the 70s, I think we saw oil surges of roughly 80% or so. But in electricity markets, we see intraday fluctuations 100-fold, 1,000-fold, 10,000-fold, not percent, but fold. So it's completely bananas. I mean, electricity is by far the most volatile commodity. So it kind of then connecting the two dots, like the most volatile commodity and storage, the more volatile a product is, the more sense it probably makes to store it. If making a comparison to, for instance, option pricing, in option prices, those of you who've studied finance know that one of the most important variables in option prices is volatility of the underlying. So when you have a very volatile underlying, which is in this case is electricity, you'll probably be able to create value by providing optionality through storage. So that's kind of where then Cactos came into play. So how do you store electricity? Well, for instance, with batteries, and that's where we started from.
Thanks. Please continue then a little more about Cactos. So
yeah,
what is it that you do, and how do you solve what is the problem that you're solving or the opportunity that you're capturing?
Yeah. So we do energy storage as a service. The background why we exist is the volatility of electricity markets. If before going into our products, let's go a little bit into why electricity is so volatile. It's because of the nature of the grid. You always, in the electricity system here, you always need to generate an equal amount of power that you're consuming. Both generation side and the demand side, volatility is increasing. In the supply side, so the generation side, it's because of increasing weather-dependent generation, wind, solar, renewables in general. And then in the demand side, which is maybe frequently overlooked, is the electrification of society. So things that used to run with hydrocarbons, passenger cars, public transport, heavy transport, industrial processes, district heating, are increasingly running with electricity, which causes fluctuations in the demand side. These two together make a volatile balance of supply and demand, which then is reflected in the market. Sometimes electricity is abundant. We see low or negative electricity prices. Sometimes it's scarce, and then, like, for instance, in winter months here, we can see quite high electricity prices. Flip side of the coin is frequency volatility. So frequency of the grid is an indicator of balance. When we have our frequency exactly at 50 hertz, it means that we have a perfect balance of supply and demand. If there is surplus in supply, frequency deviates upwards, and if the other way around, if there's a shortage of generation, then frequency goes down. And if frequency deviates too much from the 50 hertz, then you're going to have problems. In the extreme scenario, a large cascading blackout. The TSO is responsible for containing that frequency. And our idea when founding Cactos was to address these two things. So firstly, provide our clients with the option or with the possibility to hedge against electricity market risk, and then to participate in the grid services market, which is to supply frequency balancing services for the transmission system operator. So that's the background. So how we then did it, or how we're doing it, is we offer energy storage systems as a service. So we provide our clients with all the required hardware, software, as well as financing and services to participate in the electricity markets. So we deploy, in practice, we deploy a Cactos energy storage system into a factory of some sorts or a grid scale installation. Our system automatically trades the power and the capacity in the markets. We supervise the operation 24/7. If need be, we do service, maintenance, repairs, which is all included in a monthly fee. And we finance it, not on our own balance sheet, but we have a fund that we manage, an infrastructure fund, which finances the assets. So that's what we do. In short, we provide energy storage as a service.
It's not the most simple process. So let's move on to some of the lessons learned from your journey with Cactos so far. Let's maybe start from the beginning in a sense that talk to us a little about how do you know when it's time to really invest in scaling, and how did you validate market demand and product market fit?
Yeah. Every case is, of course, a little bit different. So my point of view is from Cactos, we're in an asset-heavy business. Our product includes quite expensive hardware, i.e. the battery storage units themselves. So we have certain peculiarities in comparison to, for instance, software business or something that is more scalable without the hard asset part. But in our case, we need to invest quite a bit in the energy storage systems. We use products that we've developed ourselves, but once we develop them, then they are standard. So we don't tailor individual units. They all leave the factory exactly the same. And with software parameterization, we can modify them for the needs of specific customers. Development in the beginning is, of course, always, there's all kinds of things you need to manage. Like when developing something new, as we all know here in a deep tech conference, you never have 100% certainty over your success. And even then, when you have the first iteration of the product, especially if it involves hardware, there will be problems that emerge later when it's put to field test. So in case of Cactos, we had a little bit of background in batteries before we started the company. Some of the guys had done batteries before, so we didn't start completely from scratch. But the product, the distributed energy storage system, meaning that we have many batteries, one centralized cloud system controlling them, that was novel, and we need to develop the software side, embedded software for control, and then the hardware itself. The first iteration took about 6 months to do. We launched it just before midsummer in 22, and we deployed the first commercial system on the 1st of August. It was very raw at the time. It was far from fully automatic. So in practice, we needed to manually pretty much control it at the time. But since we were self-financing, we didn't want to go for external funding in the very beginning, but did it later. Then we really had no other option. We had to do it that way because we couldn't afford to stay in the development chamber forever. But then the initial deployments were kind of slow. So we did in our first 6 months, I think we deployed 3 systems. So we could manage with all the problems that emerged. We could go on site. They were pretty close to our factory, so we could go on site, fix whatever was there to fix, and then carry on. And only then, roughly say 9 months from the beginning, we started to really scale the deployment of the first version of our system and start to fabricate them basically as quickly as we physically could. So there's a big risk if you start shipping products that are not completely ready and that cause a lot of OpEx, then there's a big chance that you'll get unhappy customers and also a massive cost for maintenance. So yeah, it's with hardware you have these types of risks.
Yeah, that's a very interesting point, that there can be a problem of selling too much too quickly.
Yeah,
but it's a good problem to have, of course. Let's talk a little bit more about the funding strategy next. Cactos has had an innovative approach of structuring different types of risk into different legal entities.
Yeah. So within Cactos, we do a few different kinds of business, you could say. We have a technology business that today is Cactos Corporation, where we develop new types of energy storage systems, related software, and so forth. It's a pretty typical tech company in the sense that it carries technological risk and risks that pertain to fabrication of electrical appliances and so forth. And then we have the long-term financing business. Our typical our typical contract with a client is a 10-year leasing contract. So we provide the client with the system for 10 years. They pay a fixed monthly fee every month for 10 years, and in exchange they get all the services and the hardware. So that business then again is quite low risk, low volatility, fixed cash flows. There's some upside then for variable cash flows because we also earn a provision on the performance of the asset. But we then wanted to package different types of risk to be financed within a different entity in order to achieve as competitive as possible cost of capital for the long-term funding of our energy storage system. So what we did is we founded an investment fund, an infrastructure fund called Cactus Fleet Finland KY, or limited partnership. So it's a limited partnership form legal entity, which is supervised by our local financial oversight authority, Finanssivalvonta, and our 100% owned subsidiary is the fund manager. When we deploy a new energy storage system, when it's installed, commissioned, and ready for use, the energy storage system is sold into the fund. All the cash flows from the contract flow into the fund, and the fund distributes whatever the clients have earned from the markets to the clients, and then whatever remains under the line to the fund investors. This way we've achieved a very competitive cost of capital. So infrastructure yield-wise, what is the expectation of infrastructure investors talking in general terms? We're frequently talking single-digit return expectations versus, for instance, venture capital, where we're talking about 30, 40, even more % on return expectations. So this way, our monthly fees are affordable for our clients, and this is because the long-term financing business is a lot less risky than Cactus's tech startup profile. If we would have done it on our own balance sheet, we would have firstly diluted the founders to very low proportionate shareholding, and also the financing would have been very expensive. So yeah, that's how we did it.
What was the trickiest part of raising the funding this way? So there's obviously the company with the IP is the provider of the technology then.
Yeah.
For the fund.
So there's of course, when we have an investment fund and basically the sole supplier of the investment fund kind of related companies, there are things that need to be covered so as to keep the investors happy that we're not too dependent on the sole source. So the negotiation of the LPA, as they call it, the limited partnership agreement, involved maybe things that are unusual for normal investment funds. It's a 70 million euro fund, out of which 35 million is equity, 35 million is debt, and we've now raised on the equity. We're very close to the hard cap, so I think we're around 29 million. We've got in commitments, so we're going to raise a further 7-ish, I think, no, 6, still earliest next year. But I think once we did those little tweaks to protect the fund investors from Cactus bankruptcy risk, then there's been great interest in the fund, and the performance has also been good. So we've been able to provide a very good yield for our investors, and we've been already paying out quite a bit in cash flows already in the first years of operation.
Yeah. How about on a more general level? What kind of observations and learnings do you have from talking to different types of investors? You end up going with infra investors, but I'm sure you talk to many different types of investors.
Yeah, so Cactus OY would be a typical venture capital play, and I think venture capital we also do have one venture capital investor, although Cactus nowadays is cash flow positive, so we're not in discussions right now for equity issuers on Cactus, but we issued equity previously to VC in Cactus. And for the VC, of course, the return expectation is high, so also tolerance for risk is high because you can't achieve a high expected return without accepting quite a bit of volatility. So in the VC world, everybody is focused on the upside. Everybody is very interested in how big this can get, how quickly this can get big, and what's the strategy to do it as quickly as possible. Then when talking about infrastructure investors, that's a lot more grayer and duller world where everything is related to the longevity, the security, the stability of the cash flow. So their downside risk is much more important than the potential upside. Of course, potential upside also plays a role because every manager wants to beat their peers. So they want you to generate a better income than they would get by investing into another infrastructure fund. So the return expectations need to be realistic, and you need to be able to then follow through and deliver them. But there, it's more focused on the risk profile. The largest risk that our clients carry is our client credit risk. So the companies that lease our units, their credit risk, are they able to pay their bills? So there was quite a big discussion on how we manage credit risk, how we keep our portfolio credit profile within the desired range, and then it's a lot like fixed income discussion. Like it's quite closely akin to a debt fund. So then you talk about credit risk rather than the massive equity upside that you would be discussing with VCs.
Yeah, I think that's just one key observation that we've had also with the climate fund, with many climate ventures and deep tech